We often hear about the magic of compounding. It's presented as a simple formula, a gentle upward slope leading to riches. But is it truly that straightforward? For most, the journey of wealth compounding is less a smooth ascent and more a winding path, often obscured by fog. We chase what we believe are the secrets, the shortcuts, the hidden formulas that will unlock sustainable growth. Yet, so much of the advice we encounter, the narratives we absorb, overlooks the fundamental and often deeply counterintuitive drivers of true wealth accumulation. Benjamin Graham, the father of value investing, taught us about Mr. Market, an erratic partner who swings between manic enthusiasm and debilitating despair. Relying solely on Mr. Market's mood for our compounding journey is like building a house on shifting sands. True, sustainable compounding isn't about catching the latest wave or deciphering cryptic market whispers. It's about something far more profound, something built on a bedrock of rigorous analysis, disciplined decision-making, and a deep understanding of human behavior. This is precisely why we are here, not to offer you magic bullets, but to deconstruct the 9 secrets that the vast majority of investors never truly discover. These aren't secret handshakes or exclusive clubs. They are, instead, deeply rooted principles from the core of strategic finance, the nuanced world of behavioral economics, and the disciplined art of capital allocation. We will peel back the layers, revealing the underlying truths that drive genuine, sustainable wealth, the truths that are consistently missed by the 99%. Are you ready to look beyond the surface? The first secret to sustainable wealth compounding lies not merely in earning returns, but in the intelligent, systematic reinvestment of those returns. This is far more nuanced than simply buying more shares or letting dividends accumulate. It's about where and how those reinvested dollars are deployed, transforming a simple return into a powerful engine of exponential growth. Consider a thriving forest. Compounding, in its truest sense, is not just about the growth of a single, magnificent tree. It's about the strategic planting and nurturing of saplings around it, utilizing the available soil nutrients, your capital, with utmost efficiency to cultivate a robust, interconnected ecosystem of wealth. This ecosystem thrives because every part contributes to the whole, and new growth is constantly being seeded. Many believe that simply holding dividend-paying stocks is the golden ticket to compounding. This is a pervasive myth. The crucial difference lies between the passive collection of dividends and the active, strategic reinvestment into genuinely superior growth opportunities. One is a gentle stream, the other is a directed force. To truly harness this secret, you must develop a framework for evaluating these reinvestment opportunities. This requires a keen assessment of a company's future prospects, the strength of its economic moat, and its demonstrated efficiency in allocating capital. The critical question becomes, is reinvesting earnings back into the current business the most effective use of capital, or are there superior external opportunities that could yield greater long-term returns? Ultimately, reinvestment is the engine, but strategic allocation is the fuel. Without this intelligent deployment, even substantial earnings can stagnate, failing to achieve the exponential growth we seek. This is where the never-discover aspect of compounding truly lies, not in the act of reinvesting, but in the asterisk quality asterisk and asterisk strategy asterisk behind that reinvestment. It's about understanding where your capital can do the most work, not just where it's easiest to put it. Sustainable wealth compounding is not solely about maximizing your potential gains. It is fundamentally about safeguarding your capital against significant losses. Benjamin Graham's timeless principle of the margin of safety remains absolutely paramount, even when we are focusing on growth-oriented assets. Without this inherent protection, the compounding journey becomes a precarious gamble. Consider what happens during periods of market turbulence. Companies that possess a robust margin of safety, characterized by low levels of debt, strong and reliable cash flow generation, and resilient, adaptable business models, do more than just weather the storm. They are strategically positioned to acquire distressed assets at bargain prices or to absorb market share from weaker competitors. This not only preserves their capital, but actively accelerates their compounding trajectory once the crisis subsides. The hidden risk for many investors is chasing high-growth stocks without any consideration for a margin of safety. This is akin to constructing a magnificent skyscraper on a foundation of shifting sand. The potential for spectacular gains is present, yes, but it is overshadowed by an equally, if not more, significant risk of complete collapse. Such a collapse can derail your compounding efforts for years, if not decades. Therefore, the practical application of this secret involves learning how to quantify a margin of safety even within growth companies. This demands more than a superficial glance at price-to-earnings ratios. It requires deep, fundamental analysis of intrinsic value, a thorough understanding of cash flow generation capabilities, and a rigorous examination of balance sheet strength. Think of it like a seasoned sailor navigating a tempestuous sea. Such a sailor doesn't merely aim for the quickest route to their destination. They ensure their vessel is impeccably seaworthy, equipped with with ample provisions and a hull built to withstand the harshest squalls. This preparation allows them to not only survive the storm, but to emerge stronger, more resilient, and ready to sail forward with renewed purpose. This is the essence of compounding with protection. A truly sustainable compounding machine isn't built on luck or fleeting market trends. It requires a business capable of consistently generating above-average returns and, crucially, a business shielded from the relentless erosion of competition. This protective shield, this vital component of enduring success, is what we call the economic moat. To understand its significance, think of a formidable moat surrounding a medieval castle. It's far more than just a ditch filled with water. It's a strategic defense mechanism, meticulously designed to make it incredibly difficult for invaders, or in our context, competitors, to breach the castle walls. In the business world, this moat isn't always tangible. It can manifest as powerful intangible assets like a beloved brand, the powerful network effects that bind customers, significant cost advantages that smaller rivals cannot match, or the efficiencies gained from operating at an immense scale. The myth we must debunk here is that compounding is purely a mathematical function. While mathematics plays a role, the true sustainability of compounding is deeply rooted in the quality and durability of the underlying business's competitive advantages. Without a strong moat, even the most impressive mathematical growth can be temporary, vulnerable to any new entrant or disruptive innovation. To identify these moats, a practical framework is essential. This involves a thorough analysis of a company's brand strength, the longevity of its patent protection, any regulatory advantages it may hold, and perhaps most importantly, the power of customer switching costs. How difficult and costly is it for a customer to move to a competitor? The greater that difficulty, the wider the moat. The moat, therefore, is not merely about protecting current profits. It is about creating a protected environment where capital can compound over decades, shielded from the constant attrition, the death by 1,000 cuts that inevitably plagues businesses without enduring competitive advantages. It is the unseen architect of long-term wealth. The path to sustainable wealth compounding is unequivocally a marathon, not a sprint. Among the most profoundly overlooked, yet powerful, secrets is the sheer force of sustained, patient capital allocation. This means allowing the intricate magic of compounding to unfold undisturbed by the incessant clamor and noise of short-term market fluctuations. Consider the contrasting journeys of two hypothetical investors. One is perpetually active, constantly trading, attempting to time the fickle market and chase fleeting trends. Their portfolio is a whirlwind of transactions, often resulting in mediocre overall returns and significantly eroded profits by transaction costs and taxes. The second investor, however, identifies fundamentally sound businesses, invests in them, and holds them for years, allowing the natural power of compounding to do the heavy lifting. Time and again, this patient approach consistently yields superior results. A significant psychological trap we must navigate is the overwhelming urge to do something when market volatility strikes. This impulse often leads to the classic investor blunder, selling valuable assets at their lowest point and then buying back in at inflated prices, directly sabotaging the compounding process. Patience, in this context, is not mere passivity. It is an act of profound strategic discipline. A practical strategy to cultivate this discipline is to implement a strict no-trade rule for your core holdings, especially during periods of market uncertainty. Instead of reacting to sentiment, focus your attention on rebalancing your portfolio only when the fundamental thesis of an investment genuinely changes, not simply because the market appears to be shifting. This principle can be understood through an intelligent analogy. Compounding is much like a slow-growing, ancient oak tree. You cannot accelerate its growth by impatiently pulling on its branches. Instead, your role is to ensure the soil is rich and fertile, the water is plentiful, and the tree is protected from damage. By providing these optimal conditions, you allow its natural, exponential growth to unfold gracefully and powerfully over time. This is the essence of time arbitrage in wealth creation. The first four secrets we've explored are not static decrees carved in stone. They are dynamic principles that evolve with shifting market landscapes and our deepening economic understanding. The fifth, and perhaps most crucial, secret is the compounding of your own investment knowledge and your capacity for adaptation. This is the engine that keeps all other secrets sharp and effective. Think of it like DNA replication. Just as genetic material diversifies and adapts over generations, your investment strategy must also evolve. What proved highly effective in the financial markets of the 20th century may not be the optimal approach in today's rapidly changing world. A continuous engagement with behavioral finance, the exploration of new valuation techniques, and a keen awareness of evolving economic landscapes are not optional extras. They are fundamental necessities for sustained success. Here lies a hidden truth. Many investors fall into a trap of complacency. They grow comfortable with outdated strategies or adopt a rigid set-it-and-forget-it mentality, neglecting neglecting the vital necessity of continuous learning. This intellectual stagnation inevitably leads to underperformance as the market itself evolves, leaving their strategies behind. To counteract this, a proactive approach is essential. Dedicate specific, consistent time each week to immersing yourself in financial literature, meticulously analyzing real-world case studies, and critically evaluating the prevailing market narratives. The insights gained from this intellectual endeavor should then be applied to refine your existing portfolio and strategy, ensuring they remain robust and relevant. Ultimately, your understanding of compounding should itself compound. This process extends far beyond mere numerical calculations. It is about cultivating the intellectual framework that underpins those numbers. Investing in your knowledge, in your ability to learn and adapt, is perhaps the most potent and enduring form of compounding there is, building a foundation for wealth that is truly resilient. We have journeyed together, moving beyond the superficial allure of simple formulas to uncover the true, often unseen, architects of sustainable wealth compounding. We've looked at the critical quality of reinvestment, not just the act of it. We've understood the paramount importance of a margin of safety, even when pursuing growth, and the indispensable power of an economic moat to shield your investments from competitive erosion. We've embraced the strategic patience required for time arbitrage and recognized that the compounding of our own knowledge is the bedrock upon which all other compounding rests. These are not arcane secrets whispered in exclusive circles, but rather profound principles that demand diligent application, rigorous critical thinking, and an unwavering long-term perspective. In a world often driven by fleeting market sentiment and the siren song of quick gains, these principles offer a compass, guiding us toward a more robust and reliable path. As Warren Buffett, a master of this craft, often reminds us, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Our exploration of these 5 secrets, which are but the foundation for the full 9, are the very bedrock for identifying and holding those truly wonderful companies. They are the tools that, when wielded with discipline, allow capital to compound effectively over time, transforming fair prices into extraordinary long-term value. The real discovery, then, lies not merely in knowing these principles. True wealth is built by integrating them into a robust, data-driven investment philosophy. This philosophy becomes your unwavering guide, helping you navigate the complexities and uncertainties of the market, not by predicting the unpredictable, but by building verifiable, sustainable wealth, one disciplined decision at a time. What core principle will you commit to deepening your understanding of, starting today?